Let's talk about loans, business loans, and the types that are out there. Now, something to consider across all loans is aside from interest rates and terms, is that some will require PGs or personal guarantees, which is the right to have liens on your personal assets along with the businesses. And also, loans may require a security interest in your assets, meaning they have the right to specific assets or to the entire company assets, and those that's called a security interest. So the most important thing about a loan is to understand how you're going to use it, because that will help you determine what type to get. So if you're going to be financing equipment or a long-term loan or a piece of land or something very short-term, that will drive the type of loan that you'd like to get. So let's get to it. What types are out there? Okay, this is not an exhaustive list. This is just a list of typical loan types. The truth is, if there's a structure that works for a company, there is probably someone willing to make a loan of that type. But these are common, and hope this helps. So an SBA loan, you've probably heard of these. They're offered by commercial banks. Typically, they're partially guaranteed by the Small Business Administration, so sometimes they're easier to get. There are two types. There's a 7A and a 504, and a 7A is a short-term, kind of maybe smaller loan for working capital purposes, and a 504 is a longer-term loan, more for larger equipment or facility or something like that. And expect an SBA loan to go through a lot of hoops to get one, and there's a tremendous amount of paperwork, but again, they're a little more lenient on your qualifications. So the next, an asset-based loan. These are loans that are tied to a specific asset in your business, such as an invoice, a piece of inventory, specific inventory, building, a piece of land. It's something asset-based, and the repayment of those loans are typically tied to a trigger point in the asset. So you collect the invoice, or you sell the inventory, or you have a set amortization schedule for a specific piece of equipment, and that they're offered by commercial banks most often. So that's an asset-based loan. A revolving loan is similar to an asset-based loan in that it's typically tied to assets. Okay, so if you have accounts receivable in your business, you may get a revolving loan, and instead of being tied to a specific invoice, it might be tied to the AR in total. So maybe you can borrow up to 80% of your AR under your revolving loan, and you can borrow and then you can repay. You can borrow and repay. So unlike an asset base where the trigger for payment is typically tied to something specific, a revolving allows you to move up and down your business, and they're typically offered by commercial banks as well, though other finance companies do them too. So that's a revolving loan. An equipment financing loan. These are much more specific, and they're usually offered by finance companies. So they're more flexible. They don't have as stringent of policies for credit typically. So you can usually get one of these if you have a very specific piece of equipment you are trying to finance. The payment terms may be flexible. It'll be a little more expensive. And you may have other opportunities in the contract, such as maintenance or warranties or things that are also beneficial in addition to just the loan. Always be careful when you do an equipment financing loan, because there may be terms at the end of the loan that are unusual, such as maybe you don't own the asset or there's a big payment at the end. So always be cognizant of what the full set of terms are on an equipment loan. Okay, a term loan. A term loan is longer term in nature, right? So, and these are for longer term financing goals. So not for something short, but if you're acquiring something or you're investing in the business long term and you expect the money to stay there for a long term, that's what this is for. They usually have scheduled payments, principal payments over 3 to 5, 7 years, maybe even 10 years, and or they may have a balloon, a large payment at the end. They're harder to get. They require a higher level of credit than other types of loans because they're broader in scope. They're issued by commercial banks, finance companies, different types of finance organizations issue these. So it's a term loan. Okay, a bridge loan. A bridge loan is something that is short in nature, opposite of term loan, right? It's very short in nature. And what you do here is the lender is giving you money for 6 months or less, just as an example. There's no set rule, but relatively short, because they know that there's a larger financing activity going to occur 4 months from now or 5 months from now, and so they'll provide you with a bridge loan to bridge you to that next larger financing activity. That larger financing activity, once it occurs, you'll pay off the bridge loan before anything else happens. And the bridge loans are typically made by friendly parties, so existing investors, existing lenders, people that are already sort of in the business with you to help, and they want to see you succeed, and they see that there's a path to do that, but they've just got to help you, and that's a bridge loan. Okay, a leveraged loan. Now, a leveraged loan is something that is typically offered by financial companies, not commercial banks. Usually commercial banks can do this, I should say. They can, but it's not as typical. So it's usually a finance company, and they're higher risk, meaning that the company is higher risk. So if there's a bigger credit risk with a company, maybe it doesn't earn as much profit, or it's in a loss position, or there's something going on that makes the company a little less creditworthy. These type of loans, leverage loans, work for these types of companies. Now expect the rates to be high. The total cost structure is higher, and they may also require some part of their return in the form of stock in the company or warrants in the company, because they're expecting a bigger return for their risk, and they'll invest in companies that have a high growth trajectory or have a high good forecast and good outlook for the future, in hopes to get their extra return at the back end on the company's performance. Convertible debt. Now, a convertible debt is something like equity, right? So if you want to raise equity, but you're not in a position to do that yet for various reasons, which is another video altogether, you might issue convertible debt. And what that does is it is something that is loaned by typically an investor, equity type investor, not a bank. An equity type investor will give you a convertible note, a convertible loan. And when you raise equity in the future, and they expect you to raise equity in the future, when you do that, their loan will convert and carry the same terms typically, and maybe slightly different, but similar to that equity. So that's convertible loan rather. So these, again, are not exhaustive. There's a ton of other types of loans, but I hope this is helpful. And for more tips and training just like this, visit our website at financepinnacle.com, where we help you understand the finances of your business just a little better.